Okay, so let's start the definition of free cash flow to equity. Good. Here I show you 4 different formulas that starts from net income. Okay, commonly it starts from net income, and the final destination is free cash flow to equity. 4 different ways of getting from net income to FCFE. How do we do that? The first 2 is a subtraction. The second half, okay, they are about multiplication. Okay, so in the second half, we are trying to interpret the same thing as a multiplicative relation. Okay, we want to make some ratio based on the concept that we're talking about. The first definition is what we already talked before. CapEx minus depreciation and amortization, right? Before I said net income plus depreciation and amortization, but that's minus is plus, right? So here we just regrouped using parentheses. CapEx minus depreciation. Why? Because we are going to call it net capital expenditure, NCE. Okay, net capital expenditure. So 투자액. This is a net amount of investment. Okay, net of what? Net of your depreciation. Okay. And then of course that depreciation is, coming from all the investment that you did before, right? So that's that. Change in non-cash working capital, right? Working capital change. That's thing I told you, inventory thing. And plus principal repaid and new debt issuance, right? So what you see over here in the 2 lines, those are the 2 important investments. One is net capital expenditure. The other is change in working capital. Long run investment, short run investment to support your sales. Make sense? Now, the third item is about debt holders, saying bye-bye to the debt holders. Okay, here is your cash to you. I repay something to you. Okay, sometimes I borrow from you, right? That's that. So that's first equation. You subtract all these things from net income, you get to FCFE. Second equation, what is that? We have 2 important items in investment. These 2, NCE and change in working capital. Voila. The last thing over here is not shown in this parenthesis, but that's taken care of by this 1 minus alpha thing. What the heck is that 1 minus alpha? Over here, we are simplifying our assumption. Okay? Over there, okay, in the first line, if you are the insider of the company, let's say you are the CEO, and you have precise information about when to borrow how much and when to repay how much, year by year going into 10 years down the road or something like that. Very detailed insider information. Okay? If you are the insider, you can do it like this, year by year. Okay? So that you can get to free cash flow to equity. But from outsider's perspective, like most of the equity analysts, right, that you want to aspire, okay, equity analysts, we are not insiders, okay, we are outsiders. We don't know how much will be repaid when in precise manner like that. Instead, we have some rough idea about how much of the proportion of investment that is paid by the debt holders, the proportion of the investment that is paid by the equity holders. So what do you mean? It's close to the leverage ratio kind of concept. The companies keep some stable, okay, usually companies try to keep some stable, something called the debt to invested capital ratio. Out of the total investment, certain portion should always be taken care of by debt holders, which means the remaining part should always be taken care of by the equity holders. Okay. For example, always 10% of the investment, we want to finance it using bankers' money. 90% of it, we're going to finance it using equity holders' money. Okay, that's the split between debt holders and equity holders, right? The portion, proportionate amount. So alpha denotes the proportion of net capital expenditure and change in working capital financed with debt. Okay, debt holders' portion of investment. 1 minus alpha must be what? 1 minus alpha must be equity holders' portion of investment. Okay, so that's the responsibility of equity holders. You have to pay out. Okay, you have to put your money to invest, equity holders' investment. Okay, that's the ratio, 1 minus alpha. Okay, we're gonna minus that one from net income to get to free cash flow to equity. By the way, alpha is defined as debt to invested capital ratio, IC. You know, it doesn't mean that it is IC, no way. But this is book value of debt plus book value of equity. Okay. Debt, what do you mean by debt? Let me be clear about this. Interest-bearing debt. This is about the financing part of it. Okay. This is not the total amount of liabilities. No. Okay. Forget about accounts payable. Forget about deferred tax liabilities. Forget about miscellaneous nitty-gritty detail amount of liabilities. Okay, that's for accountant's job. Forget. This is not accounting. Okay. I'm liberating you from the accounting, terrible accounting. All right. So this is about financing part. Okay, you have to borrow money so that you have to pay interest. Money never sleeps. So that's the amount we are interested in. Bank debt, and then IOUs. For example, what? Short-term notes. Okay, notes payable. That is different from notes payable. Is different from accounts payable. Accounts payable is about inventory. I told you before. Notes payable is about okay, 기업 kind of CP kind of things, commercial papers kind of things, right? 60 days, 30 days, short-term borrowing money, right? That's notes payable. And then corporate bond, okay, corporate bond. So that's that. And then in case the company has some financial leases, right? Lease amount, that would be it, right? The lease balance that you have, financing lease. So that's it. Whatever that incurs any interest expense should be this guy. Okay, book value of debt. And book value of equity, this is the usual book value of equity, the total amount. Okay, nice and easy accounting number. This is the only time that I praise accounting. Yeah, nice accounting number. Good. If you assume a stable leverage ratio of alpha, FCFE or FCFF would work nicely as your valuation measure. Okay, we're going to get to that idea later on. Now, NCE plus change in working capital, we call it reinvestment. And then NCE, I told you before, right? The third formula is, if you do the math, arithmetic, okay, you will realize this is equal to the second formula, second equation. You multiply, divide by the same thing, right? Net income cancels each other out. 1 you multiply by net income, that's this guy, and then minus this guy, and then the numerator, that guy. Easy, right? So we are getting to the last equation. Why do we need third equation? Because we want to get to the the most simplified equation in FCFE. Okay, what is that? All these ugly terminologies and all these ugly mathematical items reduced down into equity reinvestment rate. Okay, net income times 1 minus equity reinvestment rate, that is your free cash flow to equity. Okay, what is equity reinvestment rate? This ugly term over here, we are just labeling it as equity reinvestment rate. Okay, the proportion of reinvestment coming from equity holders' pocket, that's equity reinvestment rate. The reinvestment, NCE, and change in working capital, right? The proportionate figure that comes from 1 minus debt to invested capital ratio. Okay, and the whole thing divide by net income, that will be your equity reinvestment rate. Why do you need this? Why do you need this? Well, you were going to see this later on. Depending on your assumptions going into the future, you will have to simply impose net income, starting from net income, as long as I have some good idea about equity reinvestment rate, I'm good to go to calculate FCFE. And for example, if I assume equity reinvestment rate to be like 10%, well, FCFE will be 90% of net income. That's it. The problem may give you this kind of format, equity reinvestment rate thrown out directly to you, instead of making you to compute all these kind of ugly things, right? Makes your life a lot easier. Okay? Oh, a lot easier life. Doesn't that mean that value is imprecise and there's going nowhere? Not really. We are not going anywhere anyway. This is estimation anyway in the first place, but getting to that number easily takes you a long way. Okay. Now, free cash flow to equity. Okay. There are many ways to get to the same destination depending on the information you have in a problem. You should be able to use any of these models, right? The key idea is the same. Starting from net income, add back depreciation and subtract investment and subtract cash flow to debt holders. We are just relabeling or reforming with multiplication, etc., etc. You cannot usually get detailed debt repayment schedules, so you often end up using some fixed debt to IC ratio. And people usually ask me this question without any exception. Okay, every year they ask me, stable leverage ratio. How stable is stable? Okay, it really depends on your judgment call. 주관적이네요. Yeah, it is supposed to be 주관적이에요. Like, it's supposed to be biased anyway. You just have to be careful. And then whenever you see other people's report, you have to decipher those things, biases, right? Now, work with historical data as much as possible. This is why DCF works better for companies with long history. For example, okay, now, their historical debt to capital ratio looks like this. Walmart, okay, debt to capital ratio, just to give you some idea about what stable debt to capital ratio means. All right. If I go back 4 years in history, okay, here is Walmart's debt to capital ratio, 37%, and then it has been increasing all the way up to 50%. Whoa, seems like it is increasing like crazy. Is it unstable leverage ratio so that you would not be able to use FCFE? Right? Hold that question. And here is Walmart's history. Okay, Walmart's history, going all the way down to back to 1970, right? Now you see that, right? Now you see the change from here to here, and then what you will see is there's some average debt to capital ratio that is just bouncing back and forth, back and forth, back and forth, rather slowly, sometimes rather quickly, so other times, but it's just in that 40% range, about there, right? Some band that you can think about, 40% band over there. Okay, now is this a big movement or not? I would say no, based on my experience, right? But as a student, you may feel like uncomfortable. 10% movement, 10% movement. Okay, is that big or not? I don't know. But here's the comparison, right? Walmart, Starbucks, Netflix. Okay, Walmart, Starbucks, Netflix. If you look at Walmart, its longest blue lines, Netflix, orange lines. Okay, it's going up, but not that much drastic change. Okay, but what is interesting is Starbucks. Starbucks, take it to this perspective, right? 2 times more, right? Debt to capital ratio. It happens, right? In book value based debt to capital ratio, right? When does it happen? Sometimes the companies do some kind of leveraged buyouts or management buyouts, or they sometimes just hugely invest with a lot of borrowed money for their respective strategy. We don't know. But Starbucks, right? Their debt to invested capital ratio now stands at this point, which suggests that they would have to reduce this debt to invested capital ratio to original normal level. Okay, why? Because they will kill themselves if they keep on having this kind of exceptionally high debt to capital ratio. Whether you call it leverage ratio or a debt to capital ratio, I don't care, right? We mean the same thing. Too much debt burden, okay, you cannot sustain, so that you will have to reduce it drastically over the next couple of years or 10 years down the road. So in that case, okay, this kind of companies, I would say no, you cannot use FCFE or FCFF. For this one, I would say something called APV model will be better for valuation. We're not going to cover that APV in this semester, but that's available for you in your own study later. Okay. Now the next question I'm going to ask you later